If you're an aspiring price action trader, you have got to understand market structure, and we are here to teach it to you. We're going to give you the basics, everything you need to know, including some helpful tips and tricks that you can utilize on TrendSpider to help fast track your understanding of this fascinating concept. Let's jump into it. The first and arguably most important market structure concept to understand is the idea of trend. And there really are only three things that price can do as it relates to trend. Price can move in an uptrend, meaning higher highs and higher lows are being made. Price can move in a downtrend, meaning lower highs and lower lows are being made. And price can move sideways. Sideways price action represents periods of either accumulation or distribution. Accumulation refers to the process of gradually acquiring a significant position in a particular asset. In uptrends, accumulation appears as sideways price action that resolves in a continuation of the upward trend. In downtrends, it appears as sideways price action that results in a reversal of the trend. Distribution refers to the process of selling a significant position in a particular asset. In downtrends, distribution appears as sideways price action that resolves in a continuation of the downward trend. In uptrends, it appears as sideways price action that results in a reversal of the trend. As simple as it seems, identifying trend direction can be really difficult, and that's because the underlying trend of an asset can vary across time frames. In this example, we see that the price is in an uptrend on the 15-minute time frame, a downtrend on the 1 hour, and mostly going sideways on the daily. Pretty confusing, right? Due to this confusion, it's advisable to start your trend analysis with a top-down approach. First, identifying the trend on a higher time frame, like the daily or weekly, and then working your way down to the time frame that you're trading. In the strongest trends, there will be an alignment across time frames, meaning each time frame will be in an uptrend or a downtrend. TrendSpider's smart checklist can be configured to easily identify these conditions, but time frame continuity like this is not always common. More often than not, there will be variance in trend across time frames, and that's why it's imperative to understand where price is relative to the current trend. If you're having trouble identifying the trend that you're in, try utilizing the Zig Zag Indicator. This indicator automatically identifies key pivot levels and plots them on the chart for you. On TrendSpider, the Zig Zag Indicator can also plot horizontal levels that extend from the 5 most recent pivots, and we can utilize this functionality to create basic market structure scans and alerts, but more on that later. Now that we understand how to identify the current trend, let's talk about how to gauge expectations for where price might be headed next. Generally speaking, price is like a ball rolling downhill. It likes to continue in the direction that it's going in, and as time frames increase, it takes greater and greater effort to reverse the price from its current trend. Let's look at an uptrend example first. If the price was previously in an uptrend and is now trading within the section of price action that created the most recent high and low, the expectation is that the price will eventually put in a higher low and make another new high. Because of this expectation, traders should be looking for levels of interest to take long bias trades. But how do they find them? One way is with Fibonacci sequences. Using the Auto Fib tool on TrendSpider, if you measure a fib sequence of the previous swing, you'll want to look for where the price is relative to the levels contained within that fib sequence. Is the price in the upper or the lower half of the fib sequence? In strong trends where buyers are in full control, the price has a tendency to pull back less than in weaker trends. If the price pulls back to this middle area between the 50% and the 0.618 retracement lines and immediately bounces, making a new high, that can tell you that the trend is quite strong. If the price breaks down below that area, then it's fair to assume that a test of the low is possible. But since the price is still technically in an uptrend, the expectation would be for the previous low to hold and a new higher low to be made. If a fair value gap or order block or a previously untested point of control is present near this low, these can be both powerful magnets for price as well as low-risk places to enter long positions. The exact same concepts are true in downtrends. Measure a fib sequence from the high to the low of the previous swing. Find where the price is relative to the fib levels. Look for fair value gaps, order blocks, or untested points of control above the current price to consider short positions, and use the previous swing high as your stop loss. In a strong trend, the price will respect these basics of higher highs and higher lows, or lower highs and lower lows. But what happens when the trend is weakening? In a weakening trend, cracks will begin to form by way of failures at new highs or lows. In some cases, these failures can appear as wicks through previous highs or lows that never materialize into the next proper leg higher or lower. In the ICT philosophy, this weakening of trend can lead to what's called a break of structure. In an uptrend, a break of structure is visualized as a lower low being made, and in downtrends, it's visualized as a higher high being made. These are the first signs that the trend is changing, but often they do not represent the best times to take trades, as they can lead to reversals in which the previous higher low is tested before the new trend officially takes hold. Now that we understand how to spot both the direction of the trend and also the signs that it's weakening, let's circle back to that zigzag indicator and learn how to utilize it in TrendSpider's market scanner to hunt for these market structure setups occurring in real time. As we mentioned earlier, the zigzag indicator can draw horizontal levels that extend from the 5 most recent pivots. They're labeled A, B, C, D, and E in order from the most recent pivot, and each pivot can be defined uniquely in the scanner. All users on TrendSpider have access to several market structure scans, so let's briefly look at what's available. First, if you'd like to find stocks in basic uptrends or downtrends that are currently making new highs or lows, utilize the Simple Uptrend New High and Simple Downtrend New Low scans. If you'd like to find pullbacks or bounces within an uptrend or downtrend, respectively, use the Simple Uptrend Pullback or Simple Downtrend Bounce scans. These scans can be further refined in the way that price is defined relative to the previous pivot levels by using the within range definition. A helpful hint here is to also turn on your auto fib tool, as it will often draw a fib sequence on the most recent swing, which will provide you with an easy to read visual understanding of where the price is relative to those fib levels. Finally, zigzag can be used to identify scenarios where there's been a break in structure, again, defining the pivots relative to one another and the price relative to the pivots. If you'd like to find scenarios in which the price was previously in an uptrend and there's been a break of structure to the downside, utilize the Beginning of Uptrend Reversal Scanner. Users can utilize the Beginning of Downtrend Reversal Scanner to find scenarios in which a break of structure to the upside has occurred after a downtrend. So there you have it, a quick lesson on market structure basics, as well as some simple yet powerful scanners that you can begin employing today. We hope you enjoyed this video. Happy trading, and we'll catch you next time.